This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, in our previous session together, we looked at two main and very examinable assessable benefits, they being the living accommodation provided by the employer, and also then what we just called the use of assets, the use of other assets. Now, those are assets other than those very specifically prescribed in terms of the taxable benefit and how it is to be determined. And by far the biggest example of that type of assessable benefit, and by far the most examined assessable benefit, is what we're looking at here in the form of motor cars. Now then, up until now, in terms of Chapter 9, the lectures that you've been looking at have been recorded from FA 2017, because the techniques used, irrespective of the tax year, are exactly the same, and therefore the calculation was exactly the same. When it comes to motor cars, what we've seen over the years is that in relation to the CO2 emissions, so how dirty an engine of a car happens to be, that the CO2 emissions, the higher they are, the bigger the assessable benefit. And as we'll discover in these notes in a moment, the bands exist for various levels of CO2 emission, and then a prescribed percentage assessable benefit based on what we'll see in a moment's time. So these have changed. So it's become more expensive in tax terms to drive cars with higher CO2 emissions. It's the government trying to, I suppose, achieve two goals. Clearly, what it does do is to raise more tax revenues. But of course, they're also trying to, as they no doubt would say, to save the planet by reducing the CO2 emissions, by making it better, more taxation advantage for employees to be provided with low CO2 emission cars. Because if they're not, if it's high, they're going to be hitting their pockets in terms of a bigger taxation charge based on a higher assessable benefit. So, cars therefore. Another example of an annual benefit. What we're going to calculate in a moment's time is an annual benefit. It isn't, again, something that can be looked at outside of the context of an annual benefit. The calculation that we do is based on a 12-month period, a full tax year. So what you've got to watch for is, as per the previous exercises we did last session, is to look at from what date or until what date the benefit has been provided by the employer. So we'll work from a premise of a full tax year. We have enjoyed the use of this car throughout the 18-19 tax year, 6th of April 18 to the 5th of April 19 there. But if, of course, we haven't enjoyed the use of the car for the full tax year, then we're going to time a portion. Again, we start by calculating the assessable benefit, but if we've only had the use of that company car, that car provided by our employer for half of the tax year, for 6 months of the tax year, then we'll only get assessed on 6/12 of that benefit. The information that we need in determining this assessable benefit, whether it is for the full tax year or only part of that tax year. First of all, if there is no private use, it is not going to be that way. But if there were no private use of the car, then there would be no taxable benefit. So what we're going to see is a car provided by the employer for the employee, where, of course, some of the use of that car is indeed private. Wherever there is private use, it creates the determination of this assessable benefit. Now, the benefit is computed using two main figures. The benefit is a percentage. The percentages are provided here and will be on your rates and allowances page. That information that I've highlighted there, that information will be provided to you on your rates and allowances page in your examinations. It's based on a percentage of the car's list price. The list price. Now that is not necessarily the actual cost that was paid by the employer for that car. It is the list price. So do read the question carefully. Do they give you both? Do they give you both a list price and also a cost? We use the list price. And that is true whether, of course, it is a new car provided for the employee by the employer, whether indeed they bought a second-hand car. Doesn't matter what the cost is, it is the list price that we use. So that's the first piece of information you go searching for within your examination question, the list price. Now then, that list price will be given to you. You can't work an assessable benefit unless you are told that. But that list price will also include, if you are given this further additional information, list price includes the list price of any accessories fitted to the car. So again, if when you had the car, again, little luxuries, accessories like seats, for example, no, I jest. But if you've had that sunroof put in the car, if you've had some other, again, entertainment system included in the car, something over and above the normal list price for that basic model, then we add those figures to the basic list price in, of course, determining then what to base the assessment upon. So we add in the list price of those accessories. The list price is reduced, however, by any capital contribution from the employee, subject to a maximum of £5,000. Yeah, what may happen is that the individual employee may actually make a capital contribution towards the cost of the car that will then be their company car. Reason being, maybe for that particular employee, the company puts a limit in relation to the cost of the car at, say, £20,000. But the car that the individual really wants actually costs £22,000. So the individual says to the employer, look, I'll pay the extra £2,000 so that I can have that car. In which case, that capital contribution of £2,000 will then be deducted from, remember I said it was a contribution towards the cost of the car, but what do we base the benefit on? It's the list price. So it is the list price that is then reduced by any capital contribution from the employee, subject to a maximum of £5,000. So if our individual, to get his £22,000 car, has put the extra £2,000, that £2,000 will be a deduction from the list price. Now, the list price may, of course, most likely going to be bigger than the actual cost. Some discounts there have been offered in terms of getting the customer to buy that particular car, and therefore the actual cost is less than the list price. So if actually the list price was £21,000 and he's put a contribution of £2,000, the list price 21, ignore the cost, minus the capital contribution of 2, gives us a revised adjusted list price of £19,000, then to use within the calculation of the assessment. A calculation, of course, that we're yet to see. Because what we're going to do is to take a percentage of that list price, and that's based on the CO2 emissions. Now, CO2 emissions, you may recall from when dealing with capital allowances back in Chapter 5 there. Again, we saw in terms of CO2 emissions, the higher the CO2 emission, then the lower the capital allowance that was available to us, putting it into an 8% rather than an 18% level of writing down allowance, depending on the precise level, of course, of those CO2 emissions. Well, we got rather more figures of CO2 emissions given to us now. These figures will be given again on your fact sheet that now we use. So from the question, you're going to immediately identify the list price. Do you have to adjust that for any accessories? Do you have to reduce it by any capital contribution made by the individual employee concerned? You're then going to look at the CO2 emissions. Now then, if we've got a very low emission car, now measured in terms of 50 grams per kilometre or less, then that would give us a 13% benefit percentage there to apply to that list price. So if the list price was £10,000, 13% of 10 would be £1,300 as the assessable benefit for the full tax year. Notice also that the percentages given here are based on the car being a petrol car there, being a petrol car. In which case, what happens is that those percentage rates are increased by 4% for diesel cars. viewed as being even more damaging to the planet there than petrol, and hence therefore again hit harder by the taxation system. Again, action by a government to discourage a certain type of action by taxpayers, and therefore we get an extra 4%. But the combination of all of those figures put together, if it's petrol or if it's diesel with the extra 4%, if that figure goes above 37%, we cap it, because we will not go beyond a maximum 37%. Now, again, that information about 37 is not provided. The only information we do get is what we see here in terms of these percentages based on those very specific levels of CO2 emissions. There's other stuff. This is one other bit that we have to learn here. We have to learn the 4% extra for diesel cars. We have to learn this maximum percentage at 37% there. That's the stuff that we need to learn. Now, as you'll see, as we go up in terms of these CO2 emissions, 51 to 75 grams, 76 to 94 grams there, so the benefits get higher. They're creeping up in 3 percentage points, from 13 to 16, from 16 then to 19%, until we get to a cut-off level of 95 grams per kilometre, at which point, if it's 95, exactly 95 grams per kilometre, we have a 20% figure percentage to apply to our list price. But of course, there may be, and there will be in your exam question, no doubt, examples of employees who are using a car that has got rather higher CO2 emissions than 95 grams per kilometre. So what happens if we do go above that cut-off, that base level of 95 grams per kilometre? What then happens, where it's more than 95, again, this information needs to be learned. It is not given on your fact sheet. But what we're going to do is to add an additional 1% to that 20% figure for every complete 5 grams per kilometre above 95 grams per kilometre. So what does that mean? If, for example, the CO2 emissions of the car are, say, 113 grams per kilometre. Now notice we've said here every complete 5 grams per kilometre. So what do? You pick up the CO2 emissions. If that figure is above 95, you round down the specific figure given in the question to the nearest 5, the nearest multiple of 5. So if it's 113 grams per kilometre, we round down to 110. And what we then do is to say, based at 95, it was 20%. Plus, we now need, therefore, to add another 1% for every complete 5 grams per kilometre above the 95 grams. 113 grams per kilometre I gave as my example. Round it down to the nearest multiple of 5, that's 110. Minus 95 and divide that by 5. And that will then be multiplied by 1%. So by how much does the CO2 emission, rounded down, always down to the nearest multiple of 5, that is 110, by how much does that exceed the cut-off base level of 95 grams per kilometre? Well, that's an excess, as you can see there, of 15. 15 divided by 5 is therefore 3. So we've got an extra times 3 there, an extra 3%. So that would equal 23% as the assessable benefit. I repeat, when we go above 95 grams per kilometre, pick up the precise CO2 emissions. For us it was 113, round down to the nearest multiple of 5, that therefore here is 110. Take away 95, the base level percentage. We've exceeded it by, I hope my mental arithmetic's right here, 15, divide by 5, That's an extra 3 times 1, an extra 3%. Add it on, 23%. What do we do with that percentage? We apply it to the list price of that car, as we've already stated. But of course, one other thing we'd have to do before applying it, check to see whether the car, and you'll be told this, is either diesel or petrol. If it's a petrol car, that's it. End of story. It's 23% times whatever is the list price. If, on the other hand, it is a diesel car, then it's plus 4%, and that would equal 27%. Does 27 exceed the maximum 37? No, it doesn't. So you'd now use 27% of that list price. And that would be your annual benefit. Remember, again, we started with this, your annual benefit. So if you've only had the use of the car for 6 months of the tax year, you'll have 6/12 of that annual benefit for this tax year. Remember, we are dealing with the 18-19, the 2018-19 tax year. Okay, so those are the individual components that go in to calculating this basic assessable benefit. Get your list price, adjust it if necessary, and apply to that list price the relevant percentage. Based on the CO2 emissions, you're probably in most cases going to see examples that take you above 95 grams per kilometre. What do you then do? Round down that specific figure to the nearest multiple of 5. Take 95 away from that, the cut-off base level percentage, divide by 5, so therefore multiply that, multiple by 1%, here it was 3, add that to your 20%, add in the 4% diesel if it's diesel, but only to go as high as 37%. Then apply that to your list price figure. Other little things to note. The car benefit, as we've already said, is proportionately reduced if the motor car is unavailable for periods of at least 30 days of the tax year. Now, the usual reason for that is not that it's off the road for some fault or other for that sort of length of time, but the usual issue, of course, as we've already said, is that you only become entitled to that company car. Maybe you get a promotion part way through the tax year. So you've only enjoyed the use of it for part of the tax year. It is therefore an annual benefit we time apportion. When we time apportion, we do so to the nearest month there. What may be the case is you're dealing with someone who has left an employment. So they ceased that employment part way through the tax year. So again, we've got less than 12 months. So for any and all of these annual benefits, be very careful. Have we enjoyed the use of that particular asset, that benefit, for the full 12 months? If not, you time apportion, again, based on a monthly time apportionment. Where the employee makes a contribution to the employer for the use of the car. Now, be careful here. We've already mentioned that when the car was first purchased, what the employee may do, because he wants that nicer, probably faster car there, what the employee may do is to make a one-off capital contribution towards the cost of the car. What do we do with it? We deduct it from the list price. And then that list price is used year after year after year for so ever long as that employee has the use of that particular car. What we're looking at now is something very different, but something quite common in exam questions. And that is that in order to get the benefit of that car, though this seldom happens in reality, it does a lot in exam questions. The employee may be required by the employer to make a contribution towards that car, in terms of the running costs of the car. The benefit that we are computing isn't just for the basic capital cost of the car. What this also covers is every other running expense that the employer pays for regarding that car, except one. That separate one that we'll see after cars, is fuel for the car, whether it's petrol, whether it's diesel, fuel, where there is a separate assessable benefit. But if, of course, as may very well be the case, it's a fully expensed car, usually it's a company, the employer, but the employer buys the car for the individual, but then insures that car for the individual, also then pays the maintenance costs, new tyres, service charges there. All of those costs paid for by the employer are included within this one figure of assessable benefit. So be careful. In an exam question, they tell you about the car, as we've just been discussing here. You get your list price, you get your percentage based on the CO2 emissions, and you apply one to the other here. We get that figure, we apply. That figure that we have got there is, again, as we've said, an annual benefit that we have computed. But that benefit, oh, pardon me, hang on, pardon me a moment. Okay, my apologies for that, we're back and running now. Now we're just saying that we've done our original work in terms of establishing what the assessable benefit of the car is. Again, working on an annual benefit basis and time apportioning if necessary there. We've worked that figure based on this price, based on CO2 emissions percentage. What we are then further told within the question is that in addition to that in the year, the company also paid £1,000 in terms of maintenance or service charges, £500 for some new tyres, £400 in terms of insurance for the individual. All of those costs are already covered. Don't go adding those in. Don't go showing them as an additional benefit. They're all covered within this car benefit. The only thing that isn't covered is the fuel, if paid for, any part of which is paid for by the employer, but that we'll look at separately after dealing with the car benefit. We move on to look at the fuel benefit there. Now, what may happen, because of course the employer is on an ongoing basis incurring those extra costs, what might happen, as I say, it doesn't tend to happen in reality, but it does in exam questions, which is rather more important to you. What they do is to say that the employee was required by the employer to make a contribution of £100 per month as regards the running costs of the car, towards the car, the provision of that car. Well, all we do, if it's a full year, is away from the assessable benefit that we've got. We, for example, here worked either 23 or 27% of the list price. Away from that assessable benefit, the calculated percentage of the list price. Away from that figure, we will then deduct any of these contributions. We might call them a revenue contribution on a year-on-year basis, distinct from the capital contribution that is deducted from the list price when that car was originally purchased. So watch out there. Also watch out, of course, it's £100 per month, but if he's only had the car for 6 of the 12 months of the tax year, then there's only, at £100 a month, £600 to deduct rather than the full £1,200. Again, be careful. Something like this, in terms of either a Section A or a Section B question, it's awkward. In terms of objective testing questions, remember what we said, it's all or nothing. So there's a lot of steps that you have to undertake, a lot of calculations that need to be done, things to be worked out. Any one of which, if we're careless in our approach, if we get wrong, we're not going to get the right answer, and therefore we end up getting nothing. So you have to practice this and also read that question very, very carefully indeed. Right. Not that you need more than one company car, but if you did have a second car, makes no difference. As again, the benefit of each car is simply based on its list price and CO2 emissions. We do exactly the same calculations. One situation, however, where we won't have an assessable benefit, we said earlier that if there was no private use, then there'd be no assessable benefit. What we sometimes get are what are called pool cars. Now, what that is, again here, it does not result in a company car benefit. A pool car, one provided for the use of any employee, well, any authorised employee, of course, here, to use for business purposes, and it's kept at the business place of work. It doesn't belong to an employee. It isn't theirs to use, both for business and for private. It's one that's garaged, it's kept at the place of work. Somebody needs a car to go and see a client of that nature, something like that. They go, they come back, park the car up, that's it. There is no assessable benefit. We don't tax on that. Again, though, not that likely that we'd see that. Certainly within, shall we say, an objective testing question. Maybe in a detail section C question, possibly. The 15-mark income tax question, if it did, as often they have done, deal with a lot of stuff about employment income and specifically assessable benefits. They might just throw that one in for you to pick up. There's no benefit there because that is a pool car. Okay. Go back if you need to and look at, again, what we have just been saying. And then we have example 4. Now then, I'd like you to work through on this. I'll go quickly through it again once you've had your opportunity. But I've given you the basics. I'd like you to try to apply it. Let's just see again, remind ourselves of what we're doing. Now, we're given here for 1819 various employees with the following cars. We've got Lewis to begin with. Now, as we go through, what information do we want? A new diesel-powered company car. If it's diesel, what does that mean? It means it's plus 4%, at least up to our maximum 37%. What do we then see? Provided on the 6th of August 18. That is part way through our 1819 tax year. So Lewis has not had the use of this car for the entire tax year, and therefore a time apportionment will have to be done at the end of this exercise. List price, £13,500. No information about any additional extras there. No information about any capital contribution. CO2 emissions of 122 grams per kilometre. Therefore, it exceeds, as we suspected it might, 95 grams per kilometre. Right. So just have a go at this one for the moment, and then I'll let you loose on the others, but we'll just see that you've got the right idea with this first one. Have a go at this, look at the answer in the back. When you start this up again after pausing it in a moment's time, I'll take you through that answer, but keep your eyes clear, of course, of the other answers there. We don't want to spoil what awaits us in terms of our other driving heroes that we see here in relation to this particular example. So pause now, have a go at working that one out for yourself. It's got a lot going on. It's in at the deep end, this one, which is why I'm getting you to deal with it. It's diesel. It's not a benefit provided for the whole tax year. And we have a list price, but a CO2 emissions figure that goes above 95 grams per kilometre. Okay, pause now, then we'll go through it, and then you can enjoy doing the remainder for yourself. Okay, well, hopefully you've performed on this particular exercise and got the answer as you see there, assuming I've got my calculations right, of course. But what have we got? Now then, we come out to a figure all being well of 29%. Let's see how we get that, how we accumulate that figure. We had identified, of course, a list price of £13,500. That was the original list price that we had. We then have to apply to it the relevant percentage. So to do that, what are the grams per kilometre in terms of the CO2 emissions? It's above 95. So we start at 20%, and we're going to add the 4% already for the diesel car. We picked that up, of course, early on. And then plus 1% for every complete 5 grams per kilometre above 95 grams per kilometre. Now that we've got there, as hopefully you did, to be 5%. How do we get that? We round down the 120, was it 122? But we round that down to the nearest multiple of 5, and that therefore is 120. Minus the base level percentage of 95% that we're working from, that's 25, divide by 5, times 1%, equals 5% there. So we started with 20%, adding 4% for diesel, adding 5% because of the higher CO2 emissions. That gives us a grand total of 29%. So list price, 13.5 times 29%. Now, you've done a lot of work already in relation to that. But if you missed the point that actually you only acquired the use of that car when provided on the 6th of August of 2018, then we wouldn't have done this last bit and we wouldn't have got it right on an objective testing question. All that work would have been for nothing. So again, focus very carefully on all the information provided. So from 6th of August there through to the end of the tax year, the 5th of April, we do apportionments to the nearest month. So you'd have probably been told in the question it was provided on, say, the 1st of August rather than the 6th there. Well, basically through to the end of March, it's still 8 months. So 8/12. And all being well, of course, that figure comes out to £2,610. What would you do with it? In your employment income assessment, that would no doubt start off with a salary, with any bonus that had been received during the tax year. We then list out all of our other assessable benefits, take away any allowable deductions, allowable expenses, and get a net employment income. This figure of 2,610 would have been added in deriving that figure here for Lewis. And that employment income figure, once determined, with all of these figures going into it, the add-ins for the benefits, the deductions in terms of allowable expenses, once you've got that figure into the income tax, into the employment income figure it goes, and then that total figure, that goes onto your income tax computation as earned as employment income, non-savings income. And then it's back to what we did in Chapter 2 as to how then you tax that employment income. Okay, what I'd like you to do, of course, now is to have a go at the remaining exercises there. Same idea in terms of what you're picking up. For this next one, Nico, petrol. Had the company car throughout 1819. List price, 16.4. CO2 emissions, 177 grams per kilometre. These are the bits, the pieces of information that we're looking for to be able to piece them together and then establish the benefit. Have I got those checks through? Then, as I pause at this particular point in time, and then to complete the exercise, read the cars, we'll of course have a little look then at what do we do if also, as well as providing the car for the private use of the employee, what the company also does, what the employer also does, is to provide fuel for that car as well. So next, what happens if, as well as providing the car, the company, the employer, also provides the provision of the fuel for that car as well? Now remember what we said. The car benefit that you've now practiced and hopefully feel comfortable and confident with, that car benefit also covers the various running costs of the car. Maintenance, service charges, their new tyres, whatever it might be. But it does not take account of fuel provided for private use. So we're going to face a further additional assessable benefit wherever the employer is paying for, as we'll see in a moment, any part of the private fuel costs of the employee. There will be an assessable benefit if the employer is paying for any part of that private fuel cost of the employee. Now, once again, what we're going to be calculating will be an annual benefit, as it was for the car, as it was for the use of other assets, as it was for the living accommodation. So again, if not provided for the full year, then we time apportion accordingly. The calculation, well, this is actually a simpler one. Assuming you can work out the percentage for the car, that percentage figure to apply to the list price, then all we've now got to do is pick up that same percentage used for calculating the car benefit and to multiply that by £23,400, the base figure as it is known for our fuel benefit. Again, a figure given on your fact sheet, your rates and allowances page. So we don't have to work that out. It's given. We simply have to get the percentage computed from dealing with the car benefit and use that now times £23,400. Again, remember though, as we said, what you then calculated is an annual benefit. So if we've not had that use of that private fuel for the entirety of the tax year, then you time a portion. And that's where we say here about apportioning that fuel scale charge if it's less than 12 months. Also, I said to you a moment ago that there would be the fuel benefit if the employer was paying for any part, I stressed it twice over, any part of the private fuel cost of the employee. That's the point made here. There's going to be no reduction will be made if the employee contributes, now there's an important word, towards the cost of petrol, well I should say fuel there, whether it's petrol or diesel, towards the cost of fuel for private use. If he or she, the employee, pays for all fuel used for private motoring, then the charge is cancelled. There will be no fuel benefit. That's why I made the point that there will be a fuel benefit if the company pays for any part of the private fuel. It isn't like what you saw with the car benefit, where if the employee usually was required to make a contribution to the employer for the benefit of being provided with that company car, then those annual contributions would be allowable deductions in determining the assessable benefit. But here, with fuel, we don't do that. We never ever deduct a contribution made by the employee to the employer for the private fuel cost. What we have here is simpler. It's all or nothing. If the company is paying for any part of the employee's private fuel, you do your calculation of the fuel benefit as we've just described there. If the employee is paying for all of his or her private fuel, then there is no assessable benefit. It's all or nothing. It's not that lesser bit like it was with the car. Now again, in terms of objective testing questions, you've got to make sure you've read that question very carefully to understand everything that is going on, and take care to make sure that each step along the way you get it right, because you've read carefully the information within that question there. Okay. Now, you've done example 4, where we've looked at all of our famous drivers there and the different cars that they were provided with by the employer. But now I want you to calculate the fuel benefit for each of Lewis, Nico, Fernando, Jensen and Sebastian here, assuming also that Fernando pays Speed Merchants plc, the employer, during 1819, pays £600 towards. Now, as soon as you see that word, towards the cost of private fuel, you know that therefore it's only a partial reimbursement by the employee to the employer, so the employer will be paying for some part, any part of the private fuel, and therefore there'll be a full fuel benefit. We're told here, although the actual cost of the fuel was £1,000. What does that mean? It means that neither the £600 or £1,000 figure are now relevant. That what we will do is just compute, as we would in any other situation, the fuel benefit. How do we do it? What was the benefit percentage from the car benefit calculation times our given figure, our benchmark figure here, the base figure of £23,400. In that situation, there, that cost of, so that reimbursement of £600 out of the £1,000 total private fuel cost, that payment by the employee has actually done nothing in terms of any tax saving. It's achieved nothing in taxation. Therefore, some planning thoughts to have here and for you to think about once you've done the basic mechanics in terms of this exercise. What might be an idea here is one of two things. Either if the individual the employee here, Fernando, doesn't want to make any bigger contribution to the company, and well, you'd think that's perfectly reasonable, why would I want to give more money to the company? Then could we get the company to denote that the £600 contribution, instead of being towards the cost of the private fuel, was instead for the benefit of the car? Because if it's for the benefit of the car, then that's an allowable deduction in working out the car benefit. It's not this all or nothing situation that we have in relation to fuel. But when you've worked out the fuel benefit so far as Fernando is concerned, and you've established what tax charge that would be, is he, for example, as would probably be the case, a higher rate taxpayer? Whatever that assessable benefit was, the tax charge on that is going to be 40%. That would be your marginal band to apply to that benefit. Now, 40% of what could be a significant number is going to be a lot more than the difference between those two numbers, £600 and £1,000. So in order to eliminate the tax charge that might be running into thousands of pounds, well, a better thing to do, although it's never a good choice, do I pay HMRC, do I pay my employer? But rather than paying HMRC thousands of pounds of tax charge, that tax charge could be avoided in its entirety by simply reimbursing in full the cost of the private fuel. So if the employee gave a further £400 to the employer to cover the full cost of the private fuel, the assessable benefit for fuel goes away, and therefore there'd be no charge at all, no tax cost, no assessable benefit. Okay. Have a little work through those exercises. Again, just pause at this point in time, and what I'll then do is to come back and just talk you through what we dealt with for Fernando, because that's the most interesting one. I want to make sure you've cracked it, you're happy with that before we go any further. Okay, the fuel benefits, therefore. Now, as we said, it's all based on that base level of 23,400, that figure again given on your fact sheet. We then pick up the car benefit percentages that you've already computed when you dealt with the car. Again, on Lewis, for example, it was 29%. Lewis, again, had to be a little bit careful because it's an annual benefit, hadn't had the use of that car and therefore the fuel to go with it for all of the tax year, so we time apportioned. Now, Fernando was the more interesting one, as we said. Still the same basic exercise. What's the base figure, 23,400? What was the car benefit percentage? Well, that, of course, was capped at the maximum 37%. And that gives us 8,658 as the assessable benefit. No reduction. There never is here in relation to a fuel benefit. Either there is one or there isn't one, because the contribution made by Fernando since cost of private fuel was not fully reimbursed. No reduction for the contribution made by Fernando. Why? Because the cost of private fuel was not fully reimbursed. So if Fernando was a higher rate taxpayer, that's an extra £8,658 of assessable benefit going into employment income and therefore being taxed eventually on the income tax computation at 40%. Well, 40% therefore of 8,000, that would be 3,200. So that's about 3,500. It isn't exactly, but it's about that. It's in that ballpark figure. Now that therefore is the tax charge that the individual here would have to pay to HMRC in relation to the fact that the company is paying for any part of his or her private fuel. So, what do you think it would be better to do here? Pay HMRC £3,500 in additional tax because we have a car fuel benefit? Or, going back to the question, remember, the actual reimbursement to the employer was £600 out of a total cost of £1,000 there. Well, in which case, if instead Fernando pays a further £400 to the company, therefore fully covering his private fuel cost, that's going to save £3,500 or thereabouts. So what would I rather do? Pay my company £400 or pay HMRC nearly or about £3,500? It's not rocket science, is it? So in which case, you'd pay the additional amount there. You'd cover all of your cost of private fuel, £1,000, because that, of course, is a whole lot better than getting a tax benefit charge of £3,500. Okay, nearly finished. Only other little bit that I want to cover here. This is the last little one in terms of vehicles, vans and heavier commercial vehicles. Yeah, if you're not yet up to the heady heights of having a company car, but you get the use of a company van or maybe a company lorry, another commercial vehicle there, where an employee uses an employer's van, as it would normally be, for journeys between home and work, and other private use is insignificant, there will be no benefit. Now, normally if you have private use, and private use would include going from home to work, that is private use. It's not business use there. Going from home to a place of work is private use there. But in relation to that, if it was a car, then you got yourself a car benefit. But we're more generous in terms of the use of a van, saying if basically all you do in the company van is go from home to work and a little bit of incidental, insignificant other private use is made, then we don't have to worry. However, where private use is not insignificant, and if this were an issue, you would be told it in an exam question, and I don't think you will. So where the private use is not insignificant, the tax charge, the assessable benefit, is £3,350. Again, be careful about the tax charge. The assessable benefit is £3,350. So in your employment income assessment, you will include as part of the employment income that figure, £3,350. That's not the tax on that. That is the assessable benefit. That is what is chargeable to tax there. £3,350 per annum. Again, it's an annual benefit, so if you haven't had the use of the company van for all the year, you time a portion. Only snag here for you is you've got to learn. You've got to remember that figure. It's not one that is provided to you on your fact sheet. I don't know why, but that one you're going to have to learn, I'm afraid. In addition to that, just like with cars, if we had the fuel paid for as well, there's an additional charge made for fuel provided for unrestricted private use. Again, if there's no car benefit, there's no van benefit here, then there'll be no fuel benefit either. But again, private use in terms of fuel, it's a set figure, which again, sorry, but you're going to have to learn that closer to exam date. It's not a huge amount, £633 per annum, again per annum. So time a portion if you've not had the use of that vehicle and the provision of the private fuel for the entire tax year. But it's only £633. So those are for vans and other heavier commercial vehicles. You need to learn them closer to the date and then just apply again, remember, on an annual basis. Okay, that then brings this rather important session together, to the end there rather, in relation to car benefits and fuel benefits, and a tiny little bit there dealing with the vans and heavier commercial vehicles. We'll finish off our employment income assessments next time.